Hello guys, Jeff here. Welcome to the Intelligent Investor. In today's video, we're going to look at the types of shares. Understanding shares is key to knowing how businesses grow and how you can benefit from that growth. Shares, which are also known as stock or equity, represent part ownership in a company. You can think of a company as a whole pizza. When you own shares, you own a slice of that pizza. This entitles you to a portion of the profits and a say in how the company is run. There are mainly 4 types of shares. In today's video, we are going to explore these types of shares. Let's talk about the first type of share, which is called an equity share or also an ordinary share. Ordinary shares are the most basic and most widely traded shares issued by a company. Ordinary shares represent the most fundamental form of ownership in a company. Ordinary shares come with a combination of rights and risks for the shareholders. Now let's go to the detailed breakdown of ordinary shares. Ownership rights. 1. Voting rights. Ordinary shareholders have a right to vote on important company matters. These voting rights include approving board members, voting on business proposals such as mergers and acquisitions, and also approving the compensation of top-level executives. The number of votes typically corresponds to the number of shares owned. 1 vote per share is the most common scenario. 2. Profits or dividends. Ordinary shareholders may receive a portion of the company's profits in the form of dividends. However, unlike preference shares, dividends for ordinary shares are not guaranteed. The board of directors decides whether or not to distribute dividends, and the amount of dividends distributed depends on the profit of the company. 3. Capital appreciation. Ordinary shares have the potential for capital appreciation. When the company performs well, the share price might go up. The share price of the company might also go up if its future prospects look bright, and also if there is an increased investor appetite or demand for that share. Shareholders can profit by selling the shares at a higher price than they originally bought them for. Now let us look at risks associated with ordinary shares. Just like any other investments, ordinary shares also carry risks. There are no guaranteed profits in any investment. Any investment carries a portion or a proportion of risk with it. The first risk is that there are no guaranteed dividends. The company may choose not to pay out dividends to investors and instead might choose to reinvest that money in other areas. Also, the company may not have enough profits to redistribute as dividends after covering all their expenses. The second risk is company performance. The value of a share is always tied to the performance of a company. If the company does not perform well, the price of that share might go down. This means that if the company struggles financially, the share price might go down and investors might lose money if they sell the shares for a lower price than they bought them for. The third risk associated with ordinary shares is market volatility. The market might be volatile and the prices of the share might fluctuate, and this is beyond the company's control. The prices of shares or stocks might fluctuate due to various factors such as investor sentiment, interest rates, and economic conditions. The fourth risk associated with ordinary shares is lower priority in liquidation. In the unfortunate event, the fourth risk associated with ordinary shares is lower priority in liquidation. In the unfortunate event where a company is liquidated, ordinary shareholders are the last in line to receive compensation from the assets when the company is liquidated. The compensation is first paid to creditors and then paid to the preference shareholders. Ordinary shares are suitable for investors who, 1. Have a long-term investment horizon and a high risk tolerance. 2. Are looking for potential capital appreciation and possible dividend income. 3. Want to have a say in company decisions and voting rights. Therefore, it is crucial to consider your investment goals and your risk tolerance before you consider investing in ordinary shares. Okay guys, that marks the conclusion of ordinary shares. In the next video, we will look at preference shares. If you have enjoyed this video, kindly subscribe. Thank you.